Welcome to Annuity News Now. The recent inaction by Federal Reserve Chairman Ben Bernanke has caused bond prices to rise and yields to drop. Here to discuss why this is important to you and your clients is the Director of Broker-Dealer Relations at Shurwest Financial Group in Scottsdale, Arizona, Chris Price. Chris, welcome back.
Thanks, Scott. It's always good to be back.
All right, Chris, let's start at the beginning. What's going on in the markets right now that's causing bond prices to rise and yields to drop?
It's simple supply and demand, Scott. The market's being flooded by people who are buying bonds for protection from the volatile stock market. So as the demand for the bonds grows, so does the price of the bond. Conversely, when the prices increase on the bonds, what happens is it makes the yield or the interest rates that the bonds are paying go down.
All right, Chris, eventually the market is going to stabilize and people will jump back into equities. What does this mean?
Well, that's where we begin to have problems. The decrease in demand decreases the price of the bonds because the investors' appetite for risk increases. This in turn causes investors to sell their bonds below par or at the price at which they originally purchased the bonds. And that's where investors could definitely lose some of their principal.
Chris, so in effect they're buying high and selling low. That does not sound like a very good idea.
No, it's not. Anytime that the client has potential to lose value, it's not a safe investment vehicle for them.
So Chris, how will this affect CDs?
Well, CDs, the CD rates are incredibly low right now. They don't even have much more room to fall. This low interest rate environment we're in is great if you want to borrow money, to buy a house or buy a car, but it's terrible for the savers, especially like the baby boomers and the seniors who are either at retirement or near retirement. They're the ones who really depend on the interest rates the most to either supplement their income or even supply the income they're going to need throughout their retirement.
And Chris, how will annuities be affected by all this?
Well, it's hard on insurance companies too, Scott. Annuity products that offer lifetime income guarantee riders will also need to be adjusted to be more conducive to what the economic environment is providing us. By that I mean their guaranteed lifetime income payout rates will also have to be adjusted accordingly. And with interest rates being where they are, that means they'll have to be adjusted downward.
Chris, finally, why are insurance companies able to provide a better interest rate than other fixed income options?
Annuities can be fairly complex, and we could probably dedicate an entire hour to that question alone. But here's an example that might help people to understand. Annuities are long-term investments. They have surrender charges that could last anywhere from 3 to 10 years or even longer. This means if you surrender your contract early, before the contract date is fulfilled, then you could be subject to a charge or a fee to get out of that. So by committing the money for a longer period of time, the insurance company is able to invest in longer duration interest-bearing vehicles, which provides more opportunity for the client to earn a higher rate of return.
All right, Chris, great stuff. Thanks for joining us.
Thanks for having me, Scott.
My guest has been Chris Price, Director of Broker-Dealer Relations for Shurwest Financial Group in Scottsdale, Arizona. I'm Scott Drake, and you're watching Annuity News Now.